Hi, my name's Jon Guest, and this is just going to be a short video that goes with the February 2017 edition of the Economic Review. And in that edition, there's an article on price bubbles and behavioural economics. And this short video is going to provide a little answer to go with the third question. So that question was, using a demand and supply diagram, explain how expectations about future price changes can create a bubble or a price bubble or an asset price bubble. And I think it's quite useful before we go through some simple analysis, just to quickly take a quote of exactly what we mean by an asset price bubble. So Stiglitz, very famous economist, we take his definition. His definition is as follows: if the reason the price is high today is only because investors believe that the selling price will be high tomorrow, when fundamental factors do not seem to justify such a price, then a bubble exists. Okay, so we really want to focus on what we mean by that word fundamental when we're looking and thinking about price bubbles. So to illustrate this, we're going to take a simple demand and supply diagram, which I'm assuming most of you will have seen before. We're going to assume that the market clears. We're originally at point A and the price in the market is P1. Then what happens? Well, some fundamentals in the market change, and that causes the demand curve to shift to the right. So, for example, if it's a normal good and there's increase in people's incomes, that will cause that rightward shift in demand. That obviously means that the original price P1, the market's now in disequilibrium, demand's greater than supply. This will put upward pressure on prices until they adjust to point B and the price rises to P2. And the key here is whether speculators believe that this rise in price to P2 signifies a more long-term trend. So when speculators or people in the market see the price rise from P1 to P2, do they think this is a signal that prices are going to continue to rise in the future? And this is where we could get a bubble occur in the market. So let's assume that this is the case, that people believe that this price signifies a more long-term trend or increase in prices. What would happen in the market? Well, if buyers believe that prices are going to continue to rise in the future, so they've got expectations that prices are going to rise in the future, that's going to cause them to want to buy more now before the price rises. And that in the diagram will cause the demand curve to shift to the right. So that goes from D2, and I've just put a little symbol on there, DB, to notify that it's demand that's being induced by a bubble. So that causes that rightward shift in demand. There's also going to be an effect on suppliers. So if suppliers also believe that this increase in price from P1 to P2 signifies a more long-term trend, that price is going to continue to rise, then suppliers will want to supply less today. They'll want to hold back supply if they can, if that's possible, and supply more in the future when they believe the price of the good will be higher. Well, this impact of this rightward movement in demand, buyers wanting to buy more now before the price rises, and this leftward shift in supply, suppliers wanting to supply less now and actually then be able to supply more in the future when the price is higher, that will cause a new market clearing price. So we move from point B up to point C. And we can see that's going to put upward pressure on prices, and prices are going to continue to rise from P2 to P3, and the amount traded in this diagram will go to this point here. So the underlying market fundamentals are the shift in the original demand curve from the blue line to the green line, so that would explain the movement from A to B. So that's the underlying fundamentals in the market, but this expectations has caused price to be driven up to a much higher level, and these expectations have got nothing to do with the underlying fundamentals of the market. It's just a belief that this increase in price signifies that prices are going to carry on increasing in the future, and that's led to this rightward shift in demand and this leftward shift in supply. I hope you find that little the video useful for the article Price Bubbles and Behavioural Economics that's in the February 2017 edition of the Economic Review. You'll find some written answers to the other 3 questions in the online section of the journal.